Currency FX GLE. We are going to talk about the review on this trade on USD Gen. I'm going to do a quick review of the analysis that we're going to make. We're going to look at the chart. As a traders, as me personally, I don't do automated systems, and I have to look at price action daily in order to take a trade. We are also going to look at this back test that I made on eViews. I have covered a video on autocorrelation and partial correlation. I have made videos on distribution, the kurtosis factor, which is the mean revert condition that we're looking at in that case. And on this case, I made the equation on this formula, which is the Hodrick-Prescott filter. It is a data smoothing technique, and it looks to remove short-term fluctuations and include the cycle or trend factor. So I have a listening conferences that is used on algorithms, and I want to contrast what is actually, so how an algorithm understands price action and maintains these data points that we'll still look at, just as the height of the trend, and for example, the breakout of that high. Those are conditions that can be interpret and analyze on a pretty simple way, just looking at price action. Then at last, and the most important, I will say, is the review that I have on my Excel. I'm using closing prices, and we're going to analyze the variance, the volatility, and the intraday variation. All this is intraday. I just look at the daily variations here, but this is intraday as well, and the signal is intraday because that is the time frame that I'm looking at for the execution of price. We are going to start by saying that the signal is located at the monthly open and inside the week's range from the last week of the previous month. If we look at the weekly, this is the candle over here that creates the range in which we have our execution price. So as long as the price is inside this range, we are on a valid area for execute a price and look at a possible deviation. On the monthly chart, we have two positive candles. So we are trading the second consecutive monthly close on the upside. This is it's important to always consider under what context you are in the macro timeframes. And we are trading a monthly reversal as well. So January was a reversal from December 2020. So we have this positive momentum on the upside. We already established the range from the last week, which was bullish and expanding. So that is also something important. When you have an expanding last week of the month, you can look at a continuation, like right at the start of the month. Just as we saw here, we have the continuation of this momentum at the closing price, and then we push back below the 8-day moving average, and it was only a matter of 3 days before we push above the moving average again and above the monthly open. So it is important to adjust. At this point, yes, I did consider placing a short trade, but I don't want to go against the monthly flow. That is the main thing. So once I look at this variation, which is an increase, if I position myself up here, then okay, you capture the big short. But positioning yourself at this point, once you have the increase in variation, you will get exposed to this monthly flow as a counter trend, and also you have already advanced a great amount of pips on the downside. So you are already on a neutral point. And at those points, you can expect consolidation. In this case, the neutral point was the monthly open. And this day, the 4H candle, which is this candle over here, has the largest advancement from high to low on today's on this month advancement. So if you measure the 4H candles, this is the bigger one. Now I will make a pause here and go to the charts. If we try to identify that data point, it's going to be located around this area. It's going to be this data point. Of course, this was a more notable increase of variation, and it was made at the zero or neutral value of volatility, and it was the prior movement that caused the later increases. If you want to look at a bigger picture, it was around this area. And the importance is that we have that signal identified over here. It is this candle over here. But if you see, the analysis is mainly focused on the increase of an intraday variation and the predominance that it has on price action. Now, looking at the backtest that I made on eViews, I incorporate the trend factor with this equation that removes the short-term fluctuations. For example, all these data points over here that are below the high, they are just representing noise. Once you have this breakout on the upside, which is right here, you can also identify that on the chart if you're looking at as a trader behind the screen and not going with automated systems. So at this point, we have give an importance to the increase of variation. That is the main point, one of the main points. If we want to identify an increase of variation, we have to first establish what is the normal behavior. For that, okay, if we take a look at the average variation, you will see that it is in between this area. It is concentrated in these two boundaries. And the isolation of these increases could possibly give you some signals or interesting movements, which will essentially be represented as deviations. But that is not all that you want to know. you also want to know under what context of volatility you were involved. Is the increase of variance happening at a neutral point, just as we saw over here, or is it happening at the lows or at the extremes of the volatility distance? How can you do that and interpret that on the chart? I have it over here. We have the distance from the previous month, which is this, the low and the high. We have the median value, which is this one over here, and the signal, which is this increase of variation, is isolated right here, is this data point. So the signal developed under neutral values on volatility, and one conclusion that I get from this analysis is that the volatility and variations are strongly correlated in the sense that they have like an instant reaction, but the variance with the variations behaves as a post effect. So you will first have movement, an increase, for example. You will first present an increase here at first, and this is going to be a second reaction. You will have an increase as a post effect. Now on these charts over here, I'm just contrasting the difference between variation and variance, variation and volatility and variance. So right here, I want to see the signals. So we are looking at, every time we're going to focus on the extremes, basically these data points over here. Those are the points that can be isolated on the chart. If you try to isolate these minor relationships, it's going to be really hard. I mean, you're going to have a lot of statistic problems to determine a normal or high value or low value, and those values to be respected. So if you want to capture a true signal, you have to incorporate the valid structure. Okay, so why do we focus on these extreme values? Because those are representing the extremes of the variations, which is this one's on the lower side over here. This is the variations that achieve that get out of the boundaries. So as I mentioned, these are the two boundaries that have most of the variation, and the extremes are represented in this chart on these two values over here. So this is the centric point, and these are the deviations from the centric point. This is the centric point. These are the deviations from the centric point. And it's representing the same. It's just that here I'm measuring the variation on an isolated way, and right here I have the variation and its relation with the variance, which is this over here. The variance is a post effect of variations, just as we look at over here. We have these two increases. At last, the variance is telling you how far the price is moving from all data points. That is basically the significance. So right here you have negative variations that were not able. Look at this variation of negative 4 was only able to advance this distance. Let's say it is 10. And these positive variations were able to achieve these higher values and this distance over here. And it is one. It is almost 40 to 50 distance, so 4 times to 5 times higher. I know we also have some negative variations that achieve a larger distance, like this ones, but we are focusing on the positive variations in this case because it was a bullish trade. And for example, contrasting the variation against the volatility. First, this is like a logarithmic trend, and it's telling you that the variations tend to go up. If you take like the average of all this sample, the linear trend that is in between all those points will tend to move on the upside. So this is the black line representation. Now here I'm looking at the same, the variation from the centric point, just as we saw over here from the centric point, or here from the centric point. And I want to see under what context of volatility the variation happened. At the extremes or at the lower boundaries of volatility, away from the median, in other words. Because those two boundaries are representing these deviations. They are representing how far the price moves from the median value, which is this one over here. Is this gray line. So here is the median, the centric point, and you have positive variations and negative variations on the so you have for example this strong downside variation. This one over here, it was high enough, but it was a signal that was developed at the extremes of the volatility. So you are pretty deviate from the centric value at that point. So it's just once you have the signal, for example, this lower variation was not developed inside the week's range or close to the monthly open. So that is why it is not a valid signal. But once you isolate the signal, you can analyze all the context that was behind that. And this is a little bit more advanced, but the volatility and variance here, just by looking at this curve, I know that variance above 6 and volatility above 1, which is this point over here, is an interesting value to look at deviations on the upside. So if you were to have an automated system and you want to isolate the signals again. In this case, with these data points, which are the 2-month advancement on the USD Yen, any signal above variance of 6 and volatility of 1 was more reliable than the signals below those values. Here is the value of 6. So this value represents this over here. And the volatility above 1 is just these values over here. So when the volatility is surpassing those values and surpassing this one over here, you can have interesting movements playing out. Now, at last, on this EViews test, here on the equation, as I say, it is important to consider how an automated system will look at things. And one of the practical factors that I can get from that, if I will not do automated systems, is that on trend conditions, you will have an increasing average. So the median price, which in this case was this one over here, where you have the highest concentration, towards that value. And in the price is around this area over here. If you have this predominant condition on one side, this average will increase. So the algorithm in this case is able, if you incorporate this equation, is going to be able to highlight the average, which in this case is 105. And 105 is around this area. And here on price, for example, 105 is at this point. So it's telling you that on this continuation of the trend, this 105 was the average. And it is in alignment with our execution factor. So you want to get position below the average if you're looking at an increase. So below 105, which is around here, our signal, the monthly open is below 105 and the week's range is below 105. So I know I have a valid context. This just for formality, but this is an hypothesis test for the variance ratio. And it says it has 48% probability to surpass the average deviation. I'm going to say for more understanding, for a better understanding. So we're analyzing around 50 daily closes, which is 2 months of data. And that is saying that 25 days out of the 50 will surpass the deviation, the average deviation. If we are looking at a trend condition, we are looking at expanding factors. So the trend will have this lambda value, or the cumulative factor, which is for growth. I forgot to mention, but this equation also considers the growth factor or cumulative factor. And at last, here on the autocorrelation, this is the autocorrelation of residuals. So the residuals are the deviation, and this is saying that it takes around 15 days or 13 days to get back to the median point of a deviation. On price action, we're going to prove that. Look at this high point, and I count the days that it took for price to get back to that high, and it is 1, 5, 10. At the 15th day, you were already increasing the residual or the deviation, which is the thing that I'm measuring on this point. So this variation over here, number 1, which is the one that creates the high, is being surpassed or achieved back to the mean value at around 10 to in 15 days. So we have the autocorrelation, and we never look at data without proving it on the chart. So you need to take an example on the chart that it is correct. So the interpretation is correct. Then on the partial correlation, we don't have any stationality. Pretty much you have the signal on random days. It is what it is. Let me see if I'm missing something. Okay, at last, I was gonna cover the fundamentals behind this trade. It is important. It is proved by the Bank of International Settlements that what determines the short-term sentiment is the news flow. On Sunday, we had the GDP quarter of Japan, which is the pair that we're trading, and it was positive. This is a macro variable, the GDP of a country, and it is representing 4 months of analysis. So it is a macro point. So that is representing this over here. The last quarter of 2020, which is these 4 months on the negative side, have been recovered, and we have that value here. We have positive numbers. Now, later on important news for the yen, we have these exports and imports and trade balance. They give a higher volatility effect to exports because they represent on economics the surplus of the GDP, not the deficit. The deficit is represented by imports, and the surplus, the growth, is represented by exports. So you have 2 negative numbers, but don't get fooled. You have a positive GDP quarter. That is the important news. Don't get if you were, for example, a day trader, maybe you close your position on these values, but on the trade balance, which incorporates these 2 macroeconomic variables, you are running positive. You are 3.23 billion positive. And this is negative because it is considering the recovery from the pandemic shock on the trade balance, but it was positive in relation to the previous month. So just a little, I mean, the news should be analyzed with logic as well. You look at news to determine the news flow, the volatility that you can expect on a pair, but you have to reason those numbers. It is not just looking at green or red numbers, which is what a lot of retail traders do. And here at last, going back to the chart, I just plug in the relative strength index of 10 days and volume. I don't use it. I will make this clear. I don't use it for execution. What I use for execution is the increase of variation. First, I forgot to mention this. On the data, if I was using closing prices, this data point that doesn't get like an isolation out, like in these two cases where we have an increase of variation above the average boundary that is containing most of the data, this one over here that was our signal for January doesn't get highlighted. But why is that? If we are seeing that the distance from the previous signal down here measures the same than this one, it is because on these data points I'm using a closing prices. So on the closing price, I don't have the all these data points that I downloaded from my broker are the closing price. And that is why they are not able to capture the distance from the low to high. In this case, we did capture this increase of variation because we have a strong body candle, a strong increase in the closing price. But this increase was, in that sense, like a ghost, because this was a higher volatility period of the same magnitude than this one, but it's not highlighted by the closing price. So that is also a problem that I have listened on algorithms, that if you have an algorithm based on a closing price, you still need to consider the high and the low, or the open in some cases. But I just wanted to say that the signal of January is developed at a low relative strength, so we have enough upside potential and on the relative strength, and it was also an increase in volume. This was the volume increase right here. So you have an increase in volume, you have an increase in variation, you have this trending condition that is being respected, you have positive news flow from the GDP, and on the back test, how you're going to analyze this, I just show you lots of things right here. On this one, at last, I just have the representation of all the variables. The blue one is the price. Then the red one, which is this one very close to price, is the variations. And here the yellow is the volatility and the green is the variations. So one thing that I was looking at is that every increase of variation, for example, all this over here, is valid until you have a contraction of the variance and volatility. That is, I will backtest that later. That's just an important notice that I'm taking at this point. That was all for this video. Thank you for watching Currency FX GLE.